on innovations in measurement and theory. And I want to hand it over to Bob Merton, who is kindly chairing the session. Bob, take it away.
Oh, well, thank you, Debbie. We have two fine papers to be presented here. The first one is climate stress testing. Richard Berner and Rob Engel and Haiyun Young are Haiyun's going to be the presenter. The second one is measuring ESG returns premiums in the equity markets from our Barclays team, and we have Eric Bendor who's going to present it. The rules this afternoon, that's the only thing I'm really doing, is each of the presenters has 15 minutes. And then we'll, after both papers are presented, then we'll turn it over to Andrew Lowe, who has agreed to be the discussant for both papers, and he'll have 18 minutes. And that leaves us 12 minutes in the session for author responses and, of course, questions. So without wasting any of the valuable time in hearing from our speakers, let me turn it over to Haiyun Young and take it away.
Thank you. Thank you so much for a nice introduction. Let me share my screen. Can you see my slides and can you hear me well?
Yes.
Okay, great. Thank you so much for having me. I'm very excited to present our paper, Climate Stress Testing. This is joint work with Rob Engel and Dick Berner from NYU Stern. I think both are here with us today. And the usual disclaimer applies. The views here are the authors, not the feds. So understanding the impact of climate change on financial stability is a very important question for researchers, banks, and regulators alike. And how could climate-related shocks impose systemic risks on financial sector if banks systemically suffer large losses following a sharp increase in either transition risks or physical risks, then the climate change can matter for the financial stability. So the transition risks come from changes in policies as economies move into less carbon-intensive environment, and physical risks come from damage to property following extreme weather events or long-term change in climate patterns. And one of the key questions here is about quantification. So how much systemic risk does climate change impose on financial system? So that's the research question of our paper. So in our paper, we developed a climate stress testing methodology to test the resilience of financial institutions to climate-related risks. Our methodology is market-based and it involves 3 steps. The first step is to measure the climate risk factor. And the second step is to measure the climate beta of banks. And the climate beta of each bank will measure the exposure to the climate risk factor that we measured in the first step. And the last step is to compute systemic climate risk using the climate beta estimates from the second step. And we are going to call the systemic climate risk C risk. And the C risk is the expected capital shortfall of banks in a climate stress scenario. And we apply this methodology to large global banks to understand their climate-related risk exposure. And here are the key findings. First of all, we find that the climate beta and C risk substantially went up during 2020. The aggregate C risk of the top 4 US banks went up by $360 billion last year. And that's about 40% of their market cap. And we decomposed this increase during 2020 into 3 components. And based on the decomposition analysis, we find that the increase in C risk was primarily due to decrease in equity values of banks, as opposed to debt deterioration and increase in risk. Because this could mean that the banks were already under stress without any climate stress in 2020, we compared the C risk measure with non-stress C risk, where the non-stress C risk is the capital shortfall of banks under 0 climate stress scenario. And we find that the difference between the C-risk and non-C risk of the top 4 US banks was $245 billion. So this suggests that the effect coming from the climate stress was substantial. And lastly, we find that the banks with higher loan exposure to oil and gas industry have higher climate beta as well as higher C risk. So this corroborates the economic validity of our measure. So now let me explain each step of our methodology in detail. So first step is to measure the climate risk factor, and we use a market-based measure. We use Lederman's stranded asset portfolio return as a measure of transition risk. So the stranded asset portfolio is composed of 30% long position in energy ETF and 70% long position in coal ETF, and it's normalized by S&P 500 index. And what you see here is the cumulative return on the stranded asset portfolio, and you can see that it has been falling since 2011, and we interpret this underperformance of the gas and oil industry as a rise in transition risk. And for the time period when the coal ETF was not available, we used the average return of the top 4 coal companies. And once we have this climate risk factor, then we estimate each bank's climate beta. And the bank's climate beta is the bank's stock return sensitivity to the climate risk factor that we just measured in the first step. And we model bank stock return with 2-factor model, where the first factor is the market factor, and the second factor is the climate factor. And this loading here is what we call climate beta. And we estimate this dynamically, so we allow for volatility and correlation to be time varying, and we estimate this on a daily basis. And generally, we expect to see positive climate betas for large banks because they have large exposure to gas and oil loans. However, it's also possible to see negative climate betas if they hold large exposure to renewable energy, for instance. And here are the climate beta estimates of the top 10 US banks. And first of all, you can see that the climate betas move around. So this suggests that it's very important to estimate this dynamically, especially given the time-varying nature of climate change. And in time series, the climate betas started off from 0 in early 2000, and they fell into slightly negative territory here in the beginning of the financial crisis. And they have been rising, and there was a spike in 2020 last year here. And the peak was November last year. And the reason why we are seeing negative data here is during the financial crisis, the energy prices were on the rise while everything else was falling. So we are seeing negative betas here. And here are the climate betas of UK banks, and we find similar pattern that the beta is falling negative in their crisis, and we see that the climate betas are rising in 2020. And we did the same exercise for other countries, and this spike in 2020 was common across countries, including Canada, Japan, and France. And once we have the climate beta estimates, then we can compute the C risk, and we follow the S risk methodology. So the C risk is defined as the expected capital shortfall conditional on climate stress. And C risk depends on first, the book value of debt of the bank, that's D, and W, which is the market cap of the bank, and then long run marginal expected shortfall, which is the expected equity loss conditional on climate stress. And K is the prudential level of equity relative to assets. We set it as 8%, and we use 5.5% for Europe to account for the accounting differences. And the theta is the climate stress level, and we calibrated to 0.5 because negative 50% is the 1% quantile of 6-month return on the stranded asset portfolio. And the climate beta that we estimated in the previous step goes into this term, the long run marginal expected shortfall. Just to recap, the climate stress scenario that we're considering is the 50% fall in the stranded asset portfolio return over the 6-month time period. And here are the C-risk estimates of the top 10 US banks. So the positive numbers mean that there was expected capital shortfall, and the negative numbers can be interpreted as excess reserves. And because C-risk is not a sole function of climate beta, a bank with high climate beta in the previous plot can have low C-risk if the bank is sufficiently capitalized. And you can see that the C-risks were high during the financial crisis and the last year. And it's not surprising to see higher C-risk when the banks are undercapitalized. But later, I'm going to show you that the marginal C-risk was very low for this time period. However, it was very large for last year. And here is the C-risk plot of the UK banks. Again, we are seeing a rise in the C-risk here. And this was also common for other countries as well. Now let's zoom into 2020 and see what happened. So on the left-hand side, that's the C-risk plot of the top 10 US banks. And you can see that they jumped at the end of the first quarter. So for instance, for Citibank, green line, the C-risk went up from $20 billion to $100 billion. And on the right-hand side is the table showing the loan amount lent to gas and oil industry. And you can see that the rankings are not perfectly aligned, but they are roughly consistent. For instance, the top 4 banks in terms of C-risk were Citibank, Wells Fargo, Bank of America, and JP Morgan, and those are the top 4 on the right-hand side table. And similarly, for the UK banks, on the left-hand side, the top 2 banks in terms of C-risk are HSBC and Barclays. And again, those are the top 2 on the right-hand side table. And the C-risk the change in C-risk can be decomposed into 3 components. So the first component is contribution of debt to the change in C-risk. And the second component is the equity deterioration, the effect of equity deterioration on the change in C-risk. And the last term is capturing the effect of higher volatility or correlation. And here is the decomposition table for the US banks. And the first column here is the C-risk at the end of 2019. The second column is the C-risk at the end of 2020. And the third column is the change during the last year. And if I add up the 4 numbers here, then they add up to $364 billion. And the 3 columns here are the decomposition. And about 75% of this change in C-risk is coming from equity deterioration. And similarly, in the UK, the sum of change in C-risk of the 5 banks in UK was $134 billion, and more than 75% of it is coming from equity deterioration. So this could mean that banks were already under stress without any climate stress during the last year. So that led us to think about the marginal C-risk. So the marginal C-risk is the difference between the C-risk and the non-stress C-risk. So the non-stress C-risk is the capital shortfall without any climate stress. And you can see that the difference, the gap is opening up in 2019 and they remain high. in terms of magnitude, if I add up the top 4 banks' marginal C risk, they add up to $245 billion. So that means that the effect of climate stress was large. And this is for the UK banks. The rise is not as stark as the US banks, but you can see that they are high in 2020. And
Are you on just two minutes?
okay. And just to understand the magnitude of marginal C risk compared to the marginal S risk, you can see that roughly the marginal C risks are half of the marginal S risk in magnitude. So they are economically important. And this is for the UK banks. And lastly, to test the economic validity of our measure, what we are plotting here is the climate beta versus the log of active gas and oil loans. And you can see that the relationship is positive. And in the panel data, we tested this idea and we find consistent evidence. So to conclude, in this paper, we developed a climate stress testing methodology, and we introduced a measure called C risk, which is the expected capital shortfall of financial institutions in a climate stress scenario. And we hope this could be a useful complement to other stress testing methodologies, as well as scenario analysis. Thank you.
Well, thank you very much. Let's move on to the second paper, measuring ESG return premium. This was with Eric Bendar. Please take it away.
Thank you, Professor Merton, and thank you all for attending. Let me just share my screen. So this is joint work with my Barclays colleague, Jianling Wan and Yunpeng Sun, measuring ESG return premium in equity market. The idea of incorporating ESG consideration into investment processes has been widely adopted, despite some challenges that remain. The first and the most obvious one is the lack of consensus on ESG definition that leads to multiple ways of measuring ESG exposure to different scores by different providers, which in turn leads to question like how should investor monitor asset managers' ESG investing to avoid greenwashing and mislabeling? What defines an ESG-friendly portfolio? Another question, which is the focus of the study we did and the presentation today, is how do we measure the return effects due to ESG given an agreed upon measure of ESG? In other words, investors are asking how costly is ESG investing or incorporating ESG consideration into their investment process? Is it detrimental to performance, or maybe in fact it is beneficial? Given those companies that are adopting ESG consideration are in fact better companies. So I'll be focusing on the second question and show you some result. The most widely approach to looking at this question, which in our view is also an incorrect approach, is what we term the index approach. Major index providers offer ESG version of their primary indices, and many investors define the ESG return premium simply as the difference between the return of the ESG index and that of the parent index. Now, that is simple, but it can result in miscomputation due to the fact that the risk characteristics and the sector weights of those two indices could differ and differ substantially. What we do in this study is we introduce an alternative approach that allows investors to isolate the ESG premium while neutralizing the effect of systematic risk and sector allocation. It's a very flexible approach. It can be used to compute the ESG premium at the composite level. It can address questions like what's the premium for the individual pillar, the E, S, and G. It can address questions like what is the premium for individual industries. It can separate the effect of the level of ESG from that of the change in ESG, what we call ESG momentum. And we will show later that those two are separate. And it's equally applicable to credit markets. So the plan for the next 10 or 12 minutes is to quickly show you the pitfalls of measuring ESG return using indices. Then we'll talk about the alternative, the exposure matched approach. I'll show you some results using this approach, and we'll discuss some differences versus just using a simple regression. And then I'll show some additional applicability of this approach. So let's start with looking at one well-known index, the MSCI US ESG Leader Index, which is a ESG version of the parent index, the MSCI US Index. And if we look at the difference in return between the two, we see that over the last decade, that difference has been negative. After an initial outperformance of the ESG version, we see a consistent underperformance, which would result in the conclusion that ESG investing has been detrimental to performance. And the question is that really the right interpretation of the result? So let's look at the difference in risk characteristics between the two indices. If we look at just three of them as example, market beta, the book to market ratio, and profitability, we see that the exposure of securities in the two indices to those characteristics is different. In some cases, it's systematically different, like in the case of book to market. And for the other two, beta and profitability, the values oscillate. Either way, it means that the two indices reflect or may be susceptible to realization of risk factors, and the effect would be different, which of course would lead to a confounding effect on the performance measurement. Similarly, if we look at the sector allocation of the two indices, we see that they differ quite significantly across sectors and over time for the same sector. This is because the ESG version of those indices are not designed to match those sectors of the parent index. And even if they do, they're rebalanced infrequently and therefore over time develop sector tilts. So both of those two effects would lead to confounding effects that could result in mismeasurement of the ESG premium. What do we offer, or what do we suggest instead? We came up with an approach which we call the exposure matched approach, which is based on constructing a pair of two portfolios, which we term max ESG and min ESG. Those portfolios are based on securities from the parent index. They're designed to maximize and minimize respectively the ESG score of the portfolio while matching the sector allocation and the risk characteristics of the parent index. Since we match both the sector and the risk exposures, any difference in return between the two portfolios should be only due to the fact that their ESG score is different. So we will define the ESG premium now as the return difference between the max ESG and the min ESG portfolio. Now, this approach is agnostic to the measure of ESG score. It could be based on scores provided by commercial providers or by those of asset managers. In our study, we are using the MSCI ESG scores simply because they offer the longest and the broadest coverage of the universe. Now, specifically, what do we do? As I mentioned, we have two portfolios, the max and the min ESG. We match the sector of the parent index, and we match 5 key risk exposure of the parent index that correspond to widely known and widely used risk factors: beta, size, book to market, investment, and profitability. We also constrain the maximum deviation of the securities in our portfolio from the weight in the index of up to 50 basis points, and that's a point I'll touch on a little bit later. We look at a number of indices, the MSCI that I mentioned already, the S&P 500, the Russell 1000, and the Russell 2000, as well as European indices. And the portfolios are rebalanced on a monthly basis at the end of each month to match the index characteristics. So let's look at some results. In terms of the ESG score of the portfolios first, what we see, which is interesting, is that not only, of course, the ESG score of the max portfolio, which we see on column 2, is higher than the ESG score of the min ESG portfolio. That's by construction. But the ESG score of our portfolio is consistently higher than the ESG score of the ESG index, in this case, the MSCI US index. So we generate a portfolio that matches the parent index with better ESG score. What's more important is that the difference between the two portfolios, the max and the min, in terms of the ESG score, is substantially higher than the difference between the ESG index and that of the parent index. So we achieve this strong dispersion between the two. Now, in terms of performance, if we look at the performance difference between the max and the min ESG portfolios, which we term the ESG premium, we find that to be for the MSCI index universe 1% a year since 2009, as compared to a negative 20 basis points based on the difference between the ESG index and the MSCI parent index. So rather than finding a negative number, we find that the difference is positive with a magnitude of about 100 basis points a year. More importantly, we find that the difference seems to be fairly symmetric between the two portfolios. The max ESG outperformed the index by about 54 basis points, whereas the min ESG underperformed the index over the same period by almost the same magnitude, 46 basis points. So the effect is fairly symmetric, as we would expect or would like to see. And in terms of the time series dynamics, again, we see a time series dynamics which we see as intuitive, namely that the outperformance I mentioned of on average 100 basis points occurred mostly over the last couple of years, where ESG consideration took off and became more central to investors' management of portfolios. If we look at other indices, S&P 500, Russell 1000, 2000, we see pretty much the same dynamics. In all cases, the numbers are positive, and we see positive and negative contribution of the two portfolios, the max and the min ESG. The magnitude vary a little bit, as well as the time series, in particular that for the Russell 2000, which even though generated the highest performance, had some bumpy road. But again, overall, we see the same dynamics over time in terms of the ESG premium. What's important and interesting to see is looking at the results for European markets, which arguably were earlier to adopt ESG consideration compared to US market. And the numbers we found indeed correspond to that view. We find that first, the ESG premium has been larger at about 275 basis points for the stock 600 universe, compared with only 5 basis points based on the difference between the ESG version of the index and the stock 600 index. Again, we see a positive and negative contribution of the two portfolios. And maybe more impressively, if we look at the time series of the difference between the max and the min ESG portfolios, we see a very clear and consistent rise, stronger than in the US and earlier than in the US, again, corresponding to the earlier adoption of ESG consideration by European investors. Now, I mentioned the issue of issuer constraint. It's interesting to point that we allowed for 50 basis point deviation. Obviously, if we allowed for bigger deviation, that would yield a more concentrated portfolio as the optimizer tries to maximize further the ESG score of the portfolio. So what we see more concentrated portfolio, as we see here on this line. We, of course, going to be subject to potentially more idiosyncratic risk, but overall the results are similar. More concentrated portfolios ultimately yielded higher performance or higher ESG premium. But again, overall the time series and the magnitude of the ESG premium are very similar, despite the deviation in the weights of the individual securities compared to the weights in the index. Now, it's still worthwhile to make sure that our results are not driven by somehow maintaining exposure to various factors, even though we try to neutralize them. So we ran the traditional factor regressions, and indeed we find that the loadings on the 5 factors that we matched, as well as others, are either 0 or very close to 0. None of them are significant. The intercept is not significant either, and the R square of that of this regression is very, very low. In other words, we were able to match the exposure to those factors as intended. But this raises the question of why not just use a regression approach to begin with. In other words, one could just rank securities within the index universe into buckets, deciles or quintile, compute the return difference, and just regress the return difference on those factors and look at the intercept as a way to measure the ESG premium.
2 minutes, please.
We feel that we have at least 3 benefits of this approach. One is that we get accurate month-to-month measurement of the ESG premium. 2 is that the regression approach is only exposed and therefore doesn't lead to investable portfolios. And 3, that this approach leads to more applicable results to investors who are benchmarked to those indices and would like to incorporate ESG consideration into their investment process. As I mentioned, the approach is flexible. It can be used to look at individual sectors on the left, or individual pillars in terms of computing their the return premium for those pillars individually. It can also be used to separate the effect of ESG momentum or improvement in ESG ratings from the effect of the level itself. Given that ESG ratings are bound, obviously those two have cross effect, and it's important to separate the two. And this approach allows you to do that, looking at one while neutralizing the effect of the other. So in conclusion, we would advocate this simple approach that allows investors, on one hand, to accurately measure the ESG premium on a periodic basis, whether it's daily or monthly, to get accurate measurement. It's flexible, can be applied to individual pillars, to different geographies, to individual industries, applies equally to equity or to credit markets. And it can lead to investable portfolios that investors can use to capture the ESG premium in practice. Thank you.
Well, thank you very much. And now we'll turn to the discussion for the 2 papers. Andrew Lo, please take it away.
Okay, great. Thanks very much, Bob. Can you hear me okay?
Yes.
Okay, great. Well, first of all, thanks very much for inviting me, Debbie, to discuss these 2 papers, both of which are really interesting and all about measurement, which is right up my alley. So I'm very happy to be discussing it. And then I want to thank everybody for joining today, and also thank the donors of the GCFP for making this possible, including Bernie Horn, who is at the very beginning of the center, and of course Ben Golub, who's not here with us today, but is with us here in spirit. So I'm going to start with each of these papers in turn. I'm going to try to move quickly because there's a lot to cover. Haiyun did a great job of presenting the paper on climate stress testing. And the basic idea, the motivation for it, is this notion of stranded assets that Bob Litterman has focused on, which in his writing, he asks, can you protect your endowment, make money, and support action to reduce carbon emissions at the same time? And the answer is yes, sell stranded assets. That's his objective. And so in those, along those lines, Haiyun and Rob and Dick put together a climate-related index, which is a weighted average of the energy ETF, coal ETF, minus the S&P 500. And so this is the variable that they use to try to estimate betas, climate betas, and then with those climate betas, estimate C risk, or the exposure of climate risk to banks. So the way that they do that, as I said, is to estimate the beta relative to the market beta. What they're trying to capture is this notion of transition risk. If we're going to be going to a decarbonized strategy, then ultimately we're going to be imposing risks on financial institutions as the prices of those assets reflect that decarbonization process. And so C risk is the measure that they focus on. Now, the results really hinge on this climate beta. So I want to spend a few minutes talking about it and then discussing some of the econometrics. This is the time series that they did put together. This is the weighted average of energy, coal minus the S&P. I thought I would try to play with it a little bit, but so I decided to recreate it. I'm getting something that's similar but not identical. So I just want to caution all of you that my comments are based upon the only time series that I had, which basically used the ETFs that I got from CRISP. And when I tried to reconstruct it according to their formula, this is what I got. So it's similar, as you can see. It's identical for the first half, but the second half is slightly different. So just keep that in mind. Part of the reason that the time series looks the way it does is that it's the combination of energy and coal minus the S&P. And you can see in this graph that the S&P has gone up for a pretty significant portion of that. And so, really the dynamic is induced not just by the climate assets, but it's also by the fact that the stock market has gone up until the most recent period. Okay, I'll come back to that. How economically significant is the climate as a factor? And that's one of the things that I want to explore. So if you take a look at the regression that they run a number of them, but this is one of them. It's a simple version of it. When you've got a linear factor model, you can actually ask the question, which variables are the most important in terms of explaining variance? So if you start with this kind of a return series and linear factor model, and you calculate the variance of the left-hand side, you get this quadratic form, beta prime sigma beta. And if you divide both sides by the variance, basically you get a method of determining relative contribution of these different factors to the overall variance. So this particular term is obviously going to be the R squared of the regression. That's the part that is explained by the factors. And then the residual variance is going to be what's left over. But this particular expression is really interesting because if you take a look at elements of that quadratic form in the numerator, the elements of it are basically contributions factor by factor to the overall variance. And so one of the questions that you might ask is, given that climate is one of the factors, how important is it? Now, obviously, its importance is going to be related to its correlation to the other assets. And if you take a look at the correlation between the climate factor and the stock market as measured by the CRISP Value-Weighted Return Index, you can see that it varies. So as Haiyun mentioned, the betas vary, but that means that the correlations between these factors vary over time from minus 40% at the beginning of the sample all the way to as high as 60% in the middle of the sample. Okay, so if we use that variance decomposition to try to capture the correlations, let me show you what you get. So this is a regression of the return of Bank of America. I picked that just because it's a big bank and that's where my assets are. So I'm actually quite worried about it. If you take a look at the regression of the return of Bank of America on the stock market, on the 3 Fama-French factors, and on the climate factor, what you see is something that Haiyun mentioned, which is that you've got a negative beta on the climate factor. But with this particular set of estimates, you can now calculate the variance decomposition. And this is what we're looking at. This is the variance covariance matrix divided by the overall variance multiplied by those betas. So effectively, this is the percentage contribution of each of the factors and their covariances to the overall variance. And if you add all of the elements in this table, what you would get is the R squared, which is something on the order of 60 or 70%. So you can see that the stock market is the biggest factor. We all knew that. You can see that the book to market is marginally significant, but the size, high minus low, is the next most important factor. And way at the bottom right, the climate factor only explains 0.7% of the variance. And if you include the covariances, the rows and columns highlighted in blue, the sum is basically negative. So in other words, the climate factor actually accounts for the negative amount of variance because it's adding basically negative covariances to the overall sum. So, this suggests that the climate factor is not that important. I don't agree with that. And I think that Haiyun, Rob, and Dick are really onto something, but I'm not sure that this is the best way to capture it. I'll come to some suggestions in a minute. That's using the entire sample over 20 years. If you use the most recent sample from 2011 to the present, and you do the same decomposition, it actually gets worse. So the factor only explains 0.3% of the variance by itself, and with the covariances, it actually explains even less. And part of the problem here is that what I think the authors are trying to capture is tail risk. And tail risk is not well captured by these linear factor models. We need to add some kind of nonlinearity. And so I would suggest in a future version to include some kind of Markov switching process or Poisson process that really tries to capture the tail risk that they're going after. So from this perspective, one would be tempted to dismiss this as not relevant. I disagree with that interpretation. I think this is relevant, but I think you have to incorporate some kind of a tail risk component. The other thing to consider is that they focus on banks. And I understand why, given the importance of banks in the economy. But the fact is that banks have a lot of support with the Fed and FDIC and so on. What we really have to focus on are institutions that don't have that kind of support, namely insurance and reinsurance companies, hedge funds, sovereign entities. And so these are the institutions that I would suggest that they add to their C-risk calculations. With hedge funds, you can only get monthly data, but even monthly is better than nothing at all. And sovereign entities are really interesting because obviously they are actively engaged in thinking about climate issues. Take Norway as an example. One of the things that I wanted to know is how does Norway fare in this analysis? And I haven't done the C-risk analysis, I didn't have time, but I did check to see what Norway's performance is with these regressions because there's a Norway ETF. And interestingly, if you do the exact same analysis that Haiyun showed you, but you did it for the country of Norway with this ETF, what you find is a positive coefficient beta for climate. And when you do the variance decomposition, 7.3% of the variance is explained by the climate factor in Norway. And when you calculate the covariance, it's 14.4%. So if climate is a factor, it is going to affect Norway in spades. Same with Australia and other countries that are actually engaged in fossil fuel production. So I would encourage them to include that. Okay, and then finally, some concluding comments about how significant transition risk really is. I understand why Bob Litterman has been focusing on it at the World Wildlife Federation or Fund, but the issue is the speed with which we make that transition. For example, there's a lot of concerns about the fact that AI, and particularly autonomous vehicles, is going to have a really bad impact on unemployment in the trucking industry. And that's partly because once we start automating driving, that's going to have an almost immediate impact on employment. Contrast that with technologies like automobiles versus the horse and buggy industry or landlines versus mobile phones. There's nobody out there protesting unemployment in the landline phone industry because those transitions occurred over a period of time slowly enough to allow the population to adapt. So the question about transition risk and climate is how quickly is that going to happen? How quickly can we adapt? And we need to think about the general equilibrium implications of those price dynamics because, for example, coal is one of the dirtiest forms of energy out there. And so decarbonization, you would think, is going to affect coal immediately. Well, if you think about technologies like carbon capture and storage, there are power plants like the NRG plant at Petra Nova that is using carbon capture technologies in an experimental fashion to illustrate the fact that you can actually use coal in a clean fashion. Over the last 3 years in their Petra Nova plant, they've shown that you can actually capture 92.4% of carbon dioxide emissions from coal-powered energy. That sounds great, right? Except for the fact that over the last 3 years, the economics have changed. And so given where oil prices are at this point, they've actually shut that down. So you can see the nonlinearity in terms of the prices. Is coal going to be a problem? Well, maybe yes, maybe no. It really depends on the dynamics of these markets. So there are many different unintended consequences that to take into account. So really the bigger issue that they've hit upon is uncertainty. The fact that there's volatility of volatility. And I think this is an area where Rob's paper on caviar, on conditional autoregressive variance, could actually be very useful, including looking at options markets. And the last point I'll make is that because of the focus on climate, it is possible that climate-related stocks could become meme stocks, just like GameStop. And so those kinds of dynamics are things that could be captured by their technology, and I would urge them to take a look at it. Okay, let me turn to the second paper by Aric and co-authors. I thought this was also a really interesting measurement paper, and many of the points that they make are really not controversial. The issue of measuring ESG in comparison to broad indexes is highlighted by the great example that they use. But they had me at hello when they pointed out the fact that if you look at the MSCI USA index, there's 625 stocks in that index. The MSCI USA ESG Leaders Index, it has 275 stocks. So right away, you know that we're talking about comparing apples to oranges, and something needs to be adjusted. And so the exposure matched approach that they take is an attempt to do that. And there are a lot of useful things that they do. I think that, Eric did a great job of presenting it. First of all, they're using a tried and true empirical approach along the lines of many empirical co-authors, including Fama and French, which is that when you start looking at various kinds of factors, you want to control for other factors. And if you don't, you're going to get a mishmash of results. So when Fama and French first pointed out their book to market factor, you notice that they did a two-way sort where they sorted by book to market in one dimension, and then they sorted by market cap in another dimension, so that you can actually control for size as you look at different book to market effects. It's a time-honored tradition, and what they do in this paper is to control for the 5 Fama French factors: market size, book to market, profitability, and investment. That is not at all controversial. It makes plenty of sense. It's something that I think provides a really interesting contrast to what is being done right now, which is not to do that kind of control. So this is their approach. What they do is once they control for those factors, they construct 2 different portfolios: a maximum ESG score portfolio and a minimum ESG score portfolio, controlling for those 5 factors. And they take the difference, and that's what they call the premium. Now, that seems very much along the lines of what academics normally do, but I want to point out a couple of differences, and maybe this is more of a difference in semantics, and maybe I didn't really understand what they were doing. There aren't too many equations. In fact, there are no equations in their paper other than this one, in contrast to the previous one. And I tend to respond well to equations. It's hard for me to parse the English to figure out exactly what they did. So forgive me if I misinterpreted. But this is not a conventional definition of risk premium from the financial perspective, and that may be okay, but just bear with me, you'll see where I'm going with this. The typical approach for us to estimate a risk premium is to use a 2-pass Fama-Macbeth regression. We estimate betas with time series, and then once we have the betas, we can cross-sectionally regress them on a bunch of stocks to get the coefficient that multiplies the betas, namely the risk premia. So the way that we usually estimate risk premia is to use cross-sectional regressions of all stocks in the entire universe based upon a prior sample of time series estimates of the beta. That's not what they're doing here. And that's one issue about interpretation, because typically risk premia, the way we financial economists interpret it, is what investors are paid for taking factor risk. And that's why you want to use the entire universe to estimate it. What these guys are doing is using the data in that maximum ESG and minimum ESG portfolio, which is a subset, a proxy, for what's going on. And so that's one concern about interpreting it as an economic risk premium. So I would suggest maybe they would consider trying this 2-pass regression to see whether or not that makes sense. But the more concerning issue that I have is the fact that they're using outliers to try to estimate the premium. They're maximizing ESG with that first portfolio and minimizing ESG with that second portfolio. And while it makes some sense in terms of trying to see what the extremes are, just like the Fama French high minus low, high minus low market cap, small minus big companies. These are examples of extremes. The problem is that when you start using those extremes, in order to infer risk premium, you're going to need to take into account the bias from those extremes. So in order to do that, I need to do a little bit of a digression on order statistics. We've got a bunch of ESG scores, X1 through XN. They're independently and identically distributed, let's suppose, for the sake of argument. And let's suppose that we rank order them. So from X1 through XN, those are the actual scores. We rank order them as the smallest, the second smallest, and so on to the very largest. So we're basically reordering this in numerical order. That shuffling, the idea of rearranging them in numerical order alters the statistical distribution of these quantities. So for example, we know that the maximum of these IID random variables is not going to have a distribution F. It'll be distributed as F to the nth power. And you'll get a different distribution for the second largest and a different one for the third largest. That needs to be taken into account. But of course, and you can see here, the blue distribution is a normal 0, 1. The bright pink distribution is the maximum of 10 normal 0, 1s. The red is the distribution of 50, and the green is the distribution of 100. And the maximum of 100 normal 0, 1 variables has a mean of 2.5. So that is already more than 2 standard deviations away from the mean, even though all of them are independently and identically distributed. But the fact that you're looking at the largest one alters the distribution. But now that's not what they're focusing on. They're sorting by ESG, and then they're looking at the returns. And here it turns out that there's a statistical theory that allows you to quantify what the impact of ordering on the X's, but then doing inference on the returns will look like. And these are called induced order statistics. So if you order returns by the ESG score and pick the largest or the smallest, you will get a different distribution of so-called induced order statistics. And in a paper that I put out just recently on ESG investing, on impact investing, we actually work out the statistics of this. So I'm not trying to cite my own work for its own sake. I actually use a result here in a minute. But this is the paper where we derive the results. And what we show is that when you sort by one characteristic, but you look at the statistics of another characteristic, the correlation between ESG scores and returns will actually give you a way to measure the bias. And this is the expression that I'm going to use. Basically, what this says is that the expected return of the particular ESG, highest ranking ESG company is going to be given by the correlation between ESG scores and returns, multiplied by the cross-sectional standard deviation of returns, multiplied by the expected value of the ESG score normalized to be 0, 1. Now, I know that this seems very complicated, but the bottom line is that when you take the maximum minus the minimum, it turns out that that is automatically going to create a non-zero mean, even if the underlying returns are all 0. And in fact, in the case of the most extreme versus the least extreme, assuming that they're IID normal and making some relatively standard assumptions for the cross-sectional variability of US stocks, you're getting the maximum minimum of 100 stocks to be 6%, 6 percentage points. Now remember, they're getting about 1%. So already just the bias alone can swamp this. Now they're not looking at just the most extreme. They're looking at the second most, the third most, up to the 25 percentile for both small and large. And so these numbers are going to be smaller, but the bottom line is that there's bias and they need to take into account. So my conjecture using these order statistics arguments is that the larger the universe of stocks for which they apply it, the more likely it is that you're going to get a really big number for their methodology. And what they're getting is 1%. I showed you can get even larger numbers when you look at the outliers. One of the conjectures of the order statistics argument for bias is that when you use a larger universe, you're going to have greater cross-sectional variability. You will get a bigger bias. And in fact, what they show is that the Russell 2000, they're getting almost double, in fact, more than double the risk premium of the MSCI universe. So in conclusion, I think this is a great approach to dealing with these 5 different factors. You definitely got to control for them. But I think they may want to use a 2-pass method to estimate the risk premium, take selection bias into account, either using our methods, but more likely, given their structure is more complex, to do Monte Carlo simulation. And then you can use induced order statistics to quantify the bias. But the bottom line is to create more realistic benchmarks. And I'll conclude with one last point, which is that, Eric mentioned that that their method is investable. That may be true, but remember that investors are relatively unlikely to want to invest in a minimum ESG portfolio. And so the comparison between minimum ESG and maximum ESG is not necessarily fair, because most investors, what they're going to do is put money in a passive index fund or put it into ESG. That's a comparison that might be more relevant. And that's what people have been doing traditionally. So I would propose that they apply their methods of controlling for the 5 factors, but perhaps to use a benchmark that's a little bit more passive than the minimum ESG. It'll get them a smaller premium, but one that I think is ultimately going to be more defensible and realistic. But otherwise, really enjoyed the paper and both papers, and I encourage you to take a look at them. Thank you.
Thank you, Andrew. And I would ask for the authors to have an opportunity to respond to Andrew's remarks. I think I'll go in reverse order, just to mix it up. So perhaps, Eric, do you have any questions or comments about Andrew's remarks on your paper?
Thank you. Andrew, thank you for your thorough and detailed feedback. I think it was great. I agree with you. I think that perhaps our use of the term risk premia may have been somewhat misleading, because it does not correspond to the usual definition of a premium. We merely wanted to examine the kind of the difference that was due to exposure to ESG, but not in the pure sense of the word in terms of a premium. And I definitely would adopt your recommendation to run the Fowler-McBeth regressions and estimate it the way you suggested. With respect to the element of investability, I would argue that the usefulness of this approach for investors is twofold. One is that an investor who is interested in getting exposure to something like the S&P 500 or some other index, but would like to do it with the addition of having a benchmark which is more ESG friendly, would be able to use this approach to do that, namely by just constructing something that would be similar to the max ESG portfolio, hence a portfolio that looks very much or looks identical in terms of the risk exposure and sector allocation to a benchmark, but is more ESG friendly. So that would be the kind of passive replacement. Investors who are looking to extract return only from the exposure to ESG or believe that ESG is a factor. And I should say that we didn't really want to take a stand here on whether ESG is a priced risk factor or not. We just wanted to simply compute the return difference we saw without taking a stand on whether it is a priced factor or not. But for those investors who would like to try to extract return solely from having exposure to ESG, I believe that a long-short portfolio based on the max and the min can provide some practical way from doing that. Thank you.
Okay, thank you. Hien, you have comments or questions or response?
Yes, first of all, thank you so much for a great discussion. That was very, very helpful. And regarding your first comment on the capturing the tail risk component is very, very interesting, and it makes sense to consider. So we will think about it. But just to add a comment how we were thinking about this approach is when there is a regulation that strongly disencourages banks to make loans to oil and gas industry, then the sector will underperform. And if the bank stock sensitivity is not, if bank stock returns are not sensitive to this factor, then maybe it's fine. That's how we were thinking about it. And about considering other sectors, we are working on it, and also including analysis on other countries. Your example was very interesting. We will definitely look into other countries as well. And Rob and Dick, if you have any comments to add on, please do so.
It doesn't sound like I can start my video, but in any case, let me, oh, there we go. Yes, thanks, Andy. It's a very nice discussion. I think that we are not arguing that climate risk is a dominant feature at this point for all banks and for all times. First of all, we're allowing the betas to be time varying where you've fixed them. Second of all, the decomposition of R squared is not actually that that powerful a metric. I mean, we probably ought to be more interested in the t statistics on the coefficients. But our point of view is that we're trying to figure out what is an approach that regulators could use to decide whether one bank or another are exposed to some factor such as climate risk. And I think that that does not require it having a high explanatory power. If the movement in the factor is large, then your counterfactual forecast is that it's going to have a big impact. Now, of course, we do have to be mindful that these are estimates which have a lot of uncertainty in them, and so I don't think we want to go with these numbers and this methodology exactly to a regulatory environment. What we really think is appropriate is that this is a starting point. We're going to try to build much more confirmatory analysis based on granular data on the holdings, which actually are becoming available to us, to see whether these the holdings seem really commensurate with the kinds of betas we're getting. But you also mentioned that because climate change is a slow-moving process, that we wouldn't expect to see much. And I think actually the problem is that the prices of assets are really fundamentally determined by the forward-looking investors. And if investors suddenly are convinced that we are going to do something about transition risk, it could really knock the valuations of fossil fuel energy prices down quite substantially. And I think we've seen that for the last several years. We're seeing a rebound in them at the moment. And I think that there are multiple explanations for that, but some of that may be that it doesn't look like we're going to actually have as big a transition as maybe some people thought. Let me stop there. We're continuing to work on this problem.
Richard, is Richard there? You want to have any further comment on this?
I am, and my video similarly is stopped, but I can speak. Here we go. I just want to support what Hayun said and what Andrew suggested, which basically is to add other factors. And we are looking at that, both in the context of this work and in terms of the portfolio approach that is sort of a first cousin to this work, where we construct factor mimicking portfolios and control for other factors. So as the importance of the stranded asset portfolio, as we've defined it, we proxy what Bob Litterman did. And we want to look at other factors, and I think that's an important innovation. Last, among the jurisdictions that we're looking at, we want to extend this work to other jurisdictions. We are looking at, for example, Latin American banks, where there may be very different kinds of exposures. One could imagine that they'd be exposed to commodities and agriculture in a way that U.S. banks are not, and so the factors there may be quite different. The dynamic conditional beta estimates are likely to be quite different as well.
Okay, well, thank you. I'm looking at my clock, and we've already run over the assigned time. I could have this go on for much longer, but I know I'm taking it away from everyone's break, and personal preferences can't take precedent over the conference aggregate. So I think we'll have to stop here. But thank you all. Thank the speakers, and thank you, Andrew, as a discussant, for making this a most informative and I would say a pretty dynamic 1 hour. So thank you all, and let's move on.
Thanks.
Thanks, Bob.
you.
Thank you, everyone. So we really only have 2 minutes before the next session is supposed to start, so probably don't go away too far. Let me just regroup here for a second, and we'll bring in Jeff Melly, who is going to be the chair for the next session, and I'm going to hand it over to him when he's ready for that, but we have a few minutes.